A lot of people are wondering what happened and what caused this foreclosure crisis in the first place. There was a time when banks would not loan money to people who couldn't afford to make mortgage payments. And basically, in layman's terms, what happened was that Wall Street learned that they could securitize mortgages. In other words, they could package a large number of mortgages and sell them out in bite-sized pieces to investors. And investors would pay for those because they were generally a secure way to get paid on your investment. That resulted in trying to find enough people to buy homes so that they could securitize these mortgages. And of course, Wall Street was making a lot of money on this. Basically 2 points is what the investment bankers were making. And if you're selling out hundreds of millions of dollars of mortgages, then that's a pretty good payday, for a month's work. So that makes a lot of sense for them. However, they were putting a lot of pressure on the mortgage industry to create more mortgages. And so the mortgage industry came up with these other products, not just a fixed rate mortgage for 30 years, but then they came up with subprime mortgages, adjustable rate mortgages, giving people an opportunity to pay far less than the market rate on a monthly payment. If a mortgage was generally going to cost you 5% interest rate, they would find a way to give you a 1% interest rate for the first 3 or 4 years and then have that interest rate go up and then have a larger payment. Well, people became accustomed to those lower payments and weren't ready to make the larger payments when the mortgage is adjusted. And this caused a lot of those mortgages to go into default. In addition, the banks weren't using very good underwriting standards like they did in the past. Basically became very predictable that we were going to have this mortgage crisis when you got into the mid-2000s. No, it wasn't a surprise at all that this was going to happen. A lot of people saw this coming, and some people made a lot of money because they were able to predict that the mortgage crisis was going to occur. And in fact, I think that there was pretty much very good knowledge on Wall Street that this was going to occur as a result of the greed as well. Well, they got paid coming and going. Basically, all the securitized mortgages had insurance guaranteeing the payments. And then, so those companies like AIG and others actually did pay for the defaults and paid for the mortgages that weren't paying anymore. And so they were able to get paid that way. And then on top of that, the banks or those banks representing the securities were able to, through the foreclosure crisis, also take the homes from the public who defaulted on those payments for loans that they shouldn't have gotten in the first place. When you get foreclosed on your home, it's likely that the lender may have already been paid for your home, or at least the security would have been paid. The entities that are involved get to win 2 ways. They get to win because they made money when they securitized the loan. They get to win because they also got paid the insurance proceeds for the defaulted mortgages. And then they get to win because they also got to foreclose on your home and resell it at a significant profit. Personally, I think the people on Wall Street were smart enough to see that coming when they instituted this process at the very beginning.